about long-term investing, and this probably will be the only video about long-term investing because it's really not meant to be that complicated, and it shouldn't be that complicated. And like it says in the title, we're going to talk about this is truly what Warren Buffett's advice is, and we'll talk a little bit about his recent annual shareholder meeting for Berkshire Hathaway. Highly recommend you guys watch that video, and we are going to talk about that video a little bit during this lesson. As I always do, I posted the table of contents on my Instagram page. We'll go through quickly risk and diversification, ETFs, and expense ratios. That complicated. Oh, and it shouldn't be that complicated. All right, mute that. 13. What a 14th, 13th F is sector and industry qualifications, market cap categories, and post-lesson actions. So let's just jump right into it. The first thing we're going to talk about is risk and diversification. So when you're trying to invest for the long term, your main goal is to essentially minimize risk through diversification. And we're going to touch on the practical vocab in a second, and that will really make you understand the concept and why you do that more so. But if you find anything that you learned in this video helpful, I hope you guys consider liking the video as well as subscribing for future lessons in the future. And so if you watch the video from the recent Berkshire Hathaway annual meeting, you'll see that Warren Buffett says, it's a 5-hour video. I recommend you just watch from like 1 hour to 2:30 or something like that. It's about an hour and a half where the meat of his presentation is. The first hour is just nonsense, and then the last 2.5 hours is just him answering questions. But one of the main takeaways that he says is that if you own a cross-section of America, if you own a cross-section, okay, so I got carried away here. Let me just fix this real quick. But essentially, he says that all you need to do is trust in America's growth in the future and own a cross-section of America over a long period of time, and you are going to do very well. And a few numbers that he shared during that video, and you can catch it in the playlist on my channel in the influential investing videos. But back in 1932, about 90 years ago, the Dow Jones was traded at $40 a share. And 20 years later, it was trading at 6 times that, right? At $240 a share. And then just 70 years later, in 2020, modern day, it's trading at 580 times more than it traded in 1932, about 90 years ago, and 100 times what it traded at in 1950. So this is why it's so important to have time, right? And that's why a lot of people, especially the older people or just any finance person, always says the younger you are, the earlier you get started, the better you are going to be. And this is why, because over the long run, the stock market generally grows. Now, there's always going to be ups and downs in the middle, like where we are right now. We're probably at the beginning of a recession, and that is completely fine. And the reason why you shouldn't be afraid to invest any time along, whether you're in a recession or at the peak, is because of something called dollar cost averaging, which you'll see as the third bullet in the practical vocab section. We'll touch on that. But before we do that, I wanted to say something and point something out, which is super crazy, is that this crazy 580 times since 90 years ago or 100 times since 70 years ago, this includes every single recession that we have had, right? This includes the 2000 internet bubble. This includes the 2008 Great Recession. And that is after all that. And you still have these kind of crazy returns. And so that is why when you're talking about long-term investing, the most powerful thing on your side is time. Okay, so when we talked about a little bit about, let me move my mic. Oops, I forgot about that. When we talked a little bit about diversification, right? Why do you want to diversify? Well, every single company, it has a thing called alpha, which is in finance, they love Greeks. Later, when we talk about options trading this Saturday, there are Greeks associated with options trading. But with long-term investing, the only 2 Greeks you need to know is alpha and beta. Alpha is essentially company-specific risk. So if I invested my 100% of my portfolio in, say, a company like Apple, and then the internet, that's not a good example. Let's say Facebook, and then the internet, for some reason, we go to World War III and the internet no longer exists. Well, then Facebook is probably not going to be very useful, and your stock value is going to go to 0. This is called company-specific risk, right? And the ultimate objective of long-term investing is to minimize alpha. And the way you do that is essentially by investing in so many different kinds of companies that no one specific company, even if they go bankrupt, even if something terrible happens to maybe 5 companies you're invested in, your entire portfolio will not suffer, right? In general, because the stock market always usually grows in the long term, if you invest in enough different kinds of companies in enough different industries, then your company and your money will also grow, right? And so this comes with diversification, and it's not just diversification of companies, as I mentioned, but you want diversification of geography, diversification of industry. Basically, the more diversification you can have, the better, because then you have less risk in any specific company. Because what you really want to bet on in the long term is the general world economy, the general market of capitalism growing over time, right? And that is why diversification is so important. Another thing you want to consider is beta. So correlation with the general stock market. Most companies, and we'll talk about this in a future video, probably this Friday during my weekly recap, because I want to talk about beta and how it affects, my day trades and how I did this week. But essentially, a very good concept that we'll talk about maybe in a statistics video is correlation. A very simple understanding of correlation, which I'm sure most of you guys understand, but in case you don't, is a direct response. So if the market goes up $1, then whatever you're invested in, if it has a strong correlation with the market, it will also go up $1, right? A direct correlation. And then there are things that have no correlation, like no matter what the market does, it'll do its own thing. And then there are things that will have negative correlation, which means if the market goes up, then whatever thing has negative correlation, it will go in the opposite direction. Some say, that gold and gold stocks have negative beta because they tend to do well when the stock market declines. But personally, I do not like gold as an investment. I think having one beta is completely fine. And going along with the stock market is completely fine, and I'm going to talk about that because of what the next point is, which is dollar cost averaging. As long as you have time on your side, you don't have to worry about being correlated with market. In fact, if anything, you want to be correlated with the market. So let's go through a really, really simple example of dollar cost averaging. So let's say this is day 0. Day 1, and this isn't real days, let's just say years, whatever, year 0, year 1, year 2, year 2, 1, and year 2. Let's say we are in a really, really bad spot right now, and so over the next few years, the economy is going to grow. So let's just say right now, $0.5 a share, $1 a share, $2 a share. And then let's just say you buy, dollar cost averaging is essentially buying over time in equal increments. And why you want to do that is because you want to buy so that your average cost of all of your stocks in the total market, right? Whatever ETF or index fund you invest in is the average over all the years. And so let's just say we buy 1 share, which is times 1, each year, right? So the average would simply be the average of all these years, and you would have 1.166. And so here's the average, right? And this is a bullish scenario. And this is buy 1 stock. Okay? So let's say you have a bearish scenario, and let's just use 1 stock since it's easiest, but it goes in the other direction. Let's say it starts at 2, you go to 1, and you end up at 0.5. What is the average then? It's going to be exactly the same. Now you're like, okay, well, my average is 1.166, and the current market that exists in year 2 is 0.5. Isn't that really, really bad? And it's not a great situation, but if you have time, you can wait it out, and eventually the stock market will recover, right? Like I said, if you bought stocks 90 years ago, you would have it 580 times higher valuation than you did then. If you bought it 70 years ago, 100 times that. So in general, we know that the market will trend upwards over the long term. And so you can, if it's a bad year, if you have time on your side, you can maybe wait 3 or 4 or 5 years. When the market recovers, then the average will be below whatever market you live in, right? And that is the power of dollar cost averaging. And the reason why you want to do this is because what long-term investor mentality is trying to avoid is you saying, okay, it's a whatever market condition it is, I'm going to buy 100% of my money instead of spacing it out over time today, right now, because let's say you did it today because you're like, today is a market bottom. Well, we can't predict the future. So what if you're wrong? What if today isn't the market bottom and in fact the market will continue to go downwards? So you assumed, let's say, that today, year zero, is the market bottom, but actually this is only the beginning of a recession, and you bought all 3 stocks here and bought 0 here and 0 here. Well, then you're in a much worse situation than if you dollar cost averaged. Hopefully that makes sense. If you have any questions, feel free to DM me or leave your question in the comments or ask them at the end of this video. But that is the power of dollar cost averaging. And the reason you do that is because no one can predict the future. I know I say this a lot, but I always want to emphasize this in all my videos. No matter how smart you are, no matter how smart you think you are, nobody can predict the future. Traders are not fortune tellers. And so investors, long-term investors, are not fortune tellers as well. So we don't know when the market bottom will be. And so it's a safer choice is to average your buy-in into this general ETFs that you're going to buy over a long amount of time, and try to do it in fixed increments, like $100 every 2 weeks or whatever you choose to do, right? Yeah, so that's the idea of dollar cost averaging. The next one is dividend reinvestment plan. So I like dividends. I do 50% of my long-term investments in dividend ETFs. And the reason I do this is because, like I said, again, you're not a fortune teller. You can't tell what will the market be. So it's nice to have companies that you can rely on to pay you every month a certain amount of dividends. And usually the ETF I invest in is 4% per year dividends, which I can't do the math right now. What's 4 divided by 12? All right. 33% of your whatever you invest is paid to you in dividends, and I have half of my portfolio in that, so it'd be 0.15 or 0.16% a month, right, of whatever my total investment is in that of my total portfolio. Okay, so that is what dividend reinvestment plan is. So unfortunately, ETFs generally don't have DRIP, which is they automatically take the dividend that you get from the companies and buy new shares. And the great thing about that is they just automate it for you. A lot of companies will do that. You have to do your own research on whether or not it will allow you to do that. But if you do, I highly recommend it. Just understand, remember, like I said, the power of compound interest. This goes back to one of our first videos. Even a 1% gain a year in the long term is powerful, right? Remember when you gain, let's say 1% a week, you grow your portfolio by 60% in a year. If it's 2%, you triple your account in a year, right? That is just the power of really, really small gains over a long amount of time. That applies to long-term investing as well. And so when you get a dividend, the best thing you could do is to invest it back into your portfolio so that you can get more dividends the next year. Remember, everything said on my videos is just my opinion based on my experience trading, and it's for educational purposes only. Trading is very risky, and nothing I say is a recommendation or advice. Read the description, and please trade at your own risk. All right, so the next thing I want to jump into is ETFs and expense ratio. The average expense ratio, this is just from Investopedia, really just a Google search, for actively managed funds is between 0.5% or 1%. They rarely ever exceed 2.5%, and even honestly between 0.5% and 1% is extremely expensive. For passive index funds, which is what Warren Buffett recommends, is like he says just buy the S&P 500 and just put it in there. That typical ratio is about 0.2%. I'll put this in dollar context for you guys. So if an actively managed fund, if you invested $1,000, it'd be between $5 to $10 a year in fees for investing with them. If you have a passive index fund, then it would be $2, right? But remember, actively managed funds does not equal better, and this should not be more clear than what happened recently. Actively managed funds had just as bad as a year as the S&P 500. Okay, everyone lost money. Nobody could have predicted the coronavirus happening, and everyone lost basically the same amount of money. So why are you paying someone more money to manage a fund when you can just pay less money and get the same results, right? And so here's my entire investment strategy, and I'm going to share it right now. I invest in 2 ETFs, which is VOO, which is a general market ETF, which basically just invests in like the top S&P 500 companies, and then SPHD, which invests in the higher dividend paying companies in the S&P 500. And the expense ratios are below, as you can see. The VOO is 30 cents for every $1,000 invested. Amazing expense ratio. And the SPHD is $3 for every $1,000 invested. Now, when you have a small account, I recommend using an ETF, because when you have a small account, it's hard to invest in 100 different companies, right? Or even more than that, because you only have $1,000. And so that is why you use an ETF. An ETF allows you to diversify a small amount of money into a lot of companies without having to buy individual shares in each of those companies. Now, remember what I said earlier, you want to diversify not only in terms of types of company, which obviously investing in all the S&P 500 companies will do, but also geographic diversification. But since we live in a globalized society, the large companies in the S&P 500 already should have enough geographic diversification, in my opinion, so you don't have to do that, right? Even though they're based in the US, they're global businesses, so you're covered in terms of industry diversification and geographic diversification. So let's jump into these. I'm not going to spend too much time on these ETFs, but you can go to ETF.com and take a look at these ETFs. Look, A grade, 58, whatever. Let's see, large cap. They're mostly large companies. You can just scroll down, see their performance recently. And these may not be the best ETFs. This is just my strategy. I just like to be diversified, and I like low expense ratios. And honestly, long-term investing shouldn't be complicated. It's not complicated. So do it how you like, but this is how I like to do it. You can see how much money they manage, which is $2.5 billion. You can see the top 10 sectors that they are in, which we'll go over in a little bit, what sectors are and industries are, and what is considered a good diversification. And then you can see kind of their top 10 companies. You can actually see all of their companies as well. And so when you have a small amount of money, I recommend using an ETF. Hey, what's up, Randy? Welcome. Appreciate you waking up. When you have a small amount of money, I recommend you using ETFs because, like I said, you just don't have enough money to diversify in all these companies and buy all these shares because your portfolio is too small. But when you are big enough, if I had $1 million instead of $3 every $1,000, that would be like $3,000 for $1 million, right? And so that is when it becomes really expensive to pay these guys to run an ETF. So instead of paying them, I can just look at, this exists, right? You can just look at what companies they invested in and do it yourself, right? It's not that complicated. If you want someone, managing it a little bit, then you can pay them that fee that they ask for, which is 0.3%, but you don't have to. And that's the great thing about it. You really, have a choice when you have that much money in order to whether you want to just buy the shares yourself or let someone else or buy into an ETF and let someone else do it for you. Honestly, when you're a millionaire, how much really is $300 or $3,000 at that point? It may still be better to just let them manage this because they're actively looking at what the best dividend companies are to invest in and then doing that and making sure that you're getting kind of the best S&P 500 companies to invest in. So I'll leave that up to you guys to decide. But this is my entire long-term investment strategy. 50% in VOO, which is a growth-focused ETF, and then a SPHD, which is a dividend-focused ETF. And that's it. All right, so something which is really cool that exists is also called a Form 13F. And the SEC, which is the Securities and Exchange Commission, requires that all institutional investors, and yes, that includes Warren Buffett, that manage over $100 million in assets to disclose their equity holdings every quarter, so every 3 months. And so if we look at this link right here, we can look directly every 3 months what Warren Buffett and Berkshire Hathaway is invested in. And again, if you wanted to, you can just follow them directly and buy all these companies yourself instead of going through an ETF, right? And so that is up to you. I'll leave that completely up to you. But for me, I just invest in VOO and SPHD because I like my long-term investing to be very simple, and that's the simplest way to do it in my opinion. Now let's talk about a little bit more about diversification. So sector and industry classification. So how do you know if you are well diversified in terms of industries and company types? And so you can look here. The three primary systems that investors use to sort companies into sectors is the Global Industry Classification System, which is called GICS, the Industry Classification Benchmark, ICB, and the Thomson Reuters Business Classification, TRBC. GICS was the most common from my experience in the finance industry. And so that's kind of what I use primarily to kind of gauge what industries companies should fall in. And the beautiful thing also is if you look at ThinkorSwim, and I mentioned this last video, you can see that on the Analyze tab, and if you go to Fundamentals, under the company name, it shows you clearly what kind of industry or sector it deserves to be in. And you can also see other kind of companies and that fall in that same industry or sector. So that's also a really cool functionality of the fundamental feature in ThinkorSwim if you wanted to use that. Now let's talk about, these are the 11 sectors in GICS: energy, materials, industrials, consumer discretionary, which means consumer things that consumers can choose to buy, which is what discretionary means, like luxury goods. Consumer staples, which are required for people to live, like food and beverage. That's a consumer staple. Healthcare, financials, IT, communication services, utilities, and real estate. All the rest of those should be pretty self-explanatory. Happy to explain them. Thanks, Randy. I appreciate it. I think everyone liked it, at least everyone watching right now, which we have 4 likes. So I really appreciate you guys doing that. And so these are the 11 sectors that fall into the GICS classification system. I also included the entire GICS classification system in my master file. So if you want to go download the master file, again, that link is in the description below, and it's one of the new tabs that I've added to the master file. So in the master file now you have a risk management, you have the options, pricing or finding the right strike price options tab, which we'll go over probably next week, not this Saturday. And then also the GICS classification system if you wanted to look at that. All right, so now we talked about industry diversification. Let's talk about size diversification. So actually, if you look at VOO and SPHD, they're mostly large and mega cap companies. And well, why would you do that? It's pretty straightforward. Generally, I mean, they're less likely to fail or go bankrupt because they have more assets. So if they ever ran into trouble, they can just like start selling their machines or things that they have that they own. Versus when you're a really small company, you probably don't own that much. And so if you run into trouble, you may not have that much to sell. And so I like to invest in large companies. You can choose to diversify and find even mid cap, small cap, micro cap ETFs. Those also exist. And so how you want to diversify your long-term investing is up to you. But what is market cap? Market cap is essentially, in very, very layman terms, is like the size of the company. But basically, it's what the market value of a publicly traded company's outstanding shares is. That's probably just sounds like a mouthful. So in simple terms, it's what the size of the company, right? The equity value of the company. So if you want to look into that, go ahead and Google it. It's pretty straightforward. But this is just basically means like, okay, how big is the company? Mega caps are $200 billion or more. Large caps are $10 billion to $200 billion. Mid cap is $2 to $10 billion. Small cap is $300 million to $2 billion. And micro cap is $50 million to $300 million. And so when we talk about day trading, I always recommend people to trade above 300 million. So at least you're not investing in tiny companies, and so their stock price is not easily manipulated. And I always talk about that in my old videos, and hopefully you guys follow that recommendation. But like I said, there's really unlimited ways to trade how you feel comfortable, and trade at your own risk. Okay. So that's pretty much it. That is my entire long-term investment strategy. It's not meant to be complicated. The name of the game is simply diversification. If you are well diversified and you trust in the long-term growth of the economy, the global economy, then you will be fine. And like Warren Buffett said, even he couldn't have had that amazing returns of having like 100 times the Dow Jones Industrial Average growth in 70 years. So, start now, start as soon as possible, and make sure you dollar cost average. So invest into your long-term portfolio every week, every month, whatever interval you're comfortable with. But the most important thing is to do it consistently over a long period of time, and make sure that you keep on buying your shares over that long period of time at different price points in the market history. No matter what, if you're at the peak, if you're at the bottom, it doesn't matter, because if you're averaging, dollar cost averaging your share price, then over time you will be fine and you will have a really, really large portfolio. And that doesn't even include growth of the stock value. That doesn't include dividends. So in my dollar cost averaging example, that was purely stock price. Well, it does kind of include growth in the bullish scenario, but it doesn't include dividends, right? And so you can grow really, really quickly. And so that's the power of dollar cost averaging and long-term investment strategy. Make sure you have some sort of long-term portfolio before you day trade and swing trade. This is what I truly mean when I say don't trade with money you can't afford to lose. Make sure that you have money set aside for the future. Yes, the short-term way of trading can make you money. It can make you a great amount of money if you, I'm going to say, you have to get some sort of luck on your side, right? Nobody can predict the future. Nobody can predict, we're not fortune tellers. And so that is why, it's really about risk management, and it's not about trying to make these home run wins. You don't know what's going to happen. And so that is why you should have a long-term portfolio. And when you're day trading, it's all about risk management. So number 2, what I highly recommend is to go watch the Berkshire Hathaway annual shareholder meeting. It's in my playlist, like I said, in the influential investing videos on my channel. Number 3, comment below what you want me to cover in future lessons. And number 4, it's not required, but again, I always really push this book because it is so really, really good at cutting your understanding of technical analysis, which will be important in future lessons, which is the technical analysis of the financial markets by John J. Murphy. All right, so that is today's lesson. I'll stick around for a few more minutes to answer any questions you guys have, but please make sure you have some sort of long-term portfolio before you day trade and swing trade. And may volatility be ever in your favor during this week's trading. Any questions? Do you guys have any questions on maybe finding ETFs or the idea of alpha and diversification of company-specific risks? While I wait, I might as well look at what this actually comes out to, which is kind of crazy. 580 in 5 years, or 90 years. 580 times. How do I do that math again? But yeah, ask any questions. I'll answer them if I can. And while I kind of have these little math nerd fun over here. 580. X to the 90. And so equals 580. So 580 to the 1 over 90. Is it minus 1? Yep, minus 1. So that's that. 7.3% in over 90 years. And then 100 times over 70 years. It's about 6.8%. just to give you guys an idea. It's about a 7% growth every year, and that comes out to what the stock market is usually expected to do every year over a long period of time. All right, I don't see any questions, so thank you guys very much for watching. I hope you guys learned a lot from this video, and if you did, please consider liking this video as well as subscribing to my channel so you can catch future lessons. Best of luck, and may volatility be ever in your favor. Thank you.